So today I updated my discounted cash flow model for Amazon stock, and I thought it'd be a good time to also update you all on my recommendation for Amazon stock. As a reminder, I placed Amazon on my list of top 9 stocks to buy in 2025, and in this video I'm going to let you know if I still think it's one of my top 9 stocks to buy following my update of my discounted cash flow for Amazon stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so I'll go into valuation a little bit later in the video where I'll show you my discounted cash flow update. First, I wanted to look at some historical figures for Amazon. And most recently, the company's revenue growth has slowed down to 10.5%, and management is forecasting another slowdown in the upcoming quarter on revenue. Now, some of the segments for Amazon is growing faster than the rest of the business, and those segments are the more profitable segments, so that's good news. The Amazon Web Services segment is growing at roughly 20% per quarter, year over year. And while they don't break out specifically the growth of Amazon Prime members, that's also growing quickly as well. The segment that's growing even faster than Amazon Web Services is Amazon's advertising revenue, which is another lucrative segment that's more profitable than the e-commerce revenue it generates overall. So while Amazon's overall growth rate is slowing down, the more profitable segments are growing faster. So that's good news. When you break Amazon down, that's been a driver of profitability expansion and cash flow expansion over these last few years. And here's a demonstration of that. The cash flow from operations to sales is at record levels now at 18% on a trailing 12-month basis. And you can see that expansion over the previous decade, growing from around 9% all the way up to 18%. And again, this is a function of several factors, most notably the fact that AWS, the more profitable segment, is growing faster than the business overall, and economies in scale being achieved in the e-commerce segment worldwide. Its e-commerce operations are now profitable around the world, whereas a couple of years ago they were only profitable in North America and only in certain quarters. Now they've been consistently profitable around the world and for several consecutive quarters. And that's a result of expansion in the economies and scale. If Amazon is making several deliveries in the same neighborhood, that reduces the cost per delivery and thereby increases profitability, which has been something the company has worked on for several decades. And that's also expanding its returns on investor capital to 20%, which is really strong for a company like Amazon, which it announced in 2025 it's going to invest over $105 billion on capital expenditures. So it's easier to generate high returns on investor capital when you're investing a smaller sum. It becomes a much more difficult business task when you're investing over $105 billion annually, which is, to my knowledge, the highest of any company in the world will be spending in 2025. So it's both increasing the ROIC and it's increasing the amount of capital it's investing. That's not an easy thing to do. And in this regard, I give management a lot of credit. And when I give management a lot of credit, that makes the company more investable for me. When I know the company is in good hands, when I know their stewardship of the company's resources have been effective and have been getting even better. So that's something that I give a big plus for Amazon. So now let's look at the valuation. First, on a forward price to earnings basis, Amazon's trading at a forward PE of 26, which is on the lower end of where this business has traded for going back the last 3 years. Some of the reasons why Amazon is trading at a lower valuation include those large investments in capital expenditures. Investors see that as a risky move, and they're not as confident as I am in the management's ability to allocate that capital effectively. Secondly, the tariffs placed on China are likely to hurt Amazon, as many of the products sold on the platform come from China. And so the 20% tariffs on Chinese made goods is going to hurt the business, is going to hurt customer buying these businesses, because they might not want to pay as high a price for these products that will be impacted by tariffs. And tariffs look like they're going to expand to more countries and perhaps even higher rates of tariffs. And so all of that uncertainty is hurting the valuation for Amazon. All that being said, when I updated my free cash flow model for Amazon, I increased the free cash flow expectations over these next several years. And the most notable reason for that increase is my confidence that Amazon will continue allocating large sums of capital and getting good returns on that capital, because Amazon has such a competitive advantage in the areas that it's investing capital, right? It's investing capital in data centers optimized for AI, where Amazon is a leader in the cloud services segment. It's in first place, and second place is Microsoft, and third place is Alphabet. So I'm confident it'll continue to deliver good returns in that segment. And it's also investing some money in its e-commerce and logistics operations, which again, it holds such a large competitive advantage there. It's incorporating new generation technology, including robotics and automation, and incorporating AI to improve performance in its e-commerce business. Management has said that it continues to find ways to lower the cost per delivery. And management also said that they see so many opportunities ahead where they can continue lowering the cost per delivery. So my updated intrinsic value per share is now in the 300s. I'm forecasting the fair value per share, or calculating the fair value per share for Amazon stock at $331, and that compares very well to the current market price of $196 per share. So in addition to increasing the free cash flow forecast, I also updated the number of shares outstanding because Amazon repurchased a couple of 100 million shares. So I decreased the number of shares outstanding. They also borrowed more money, so I added their newer, higher debt balance to this total. And I also updated their non-operating assets balance, which also increased. So all of those incorporating into my free cash flow now has Amazon's intrinsic value at 331. So a lower price to earnings, a higher fair value estimate. And so it's not surprising to hear my final recommendation, which is that I'm reiterating that I think Amazon is one of the top 9 stocks to buy right now at current prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.